Before we dive in, it's crucial to understand that the information in this video is for educational and informational purposes only. I am not a financial advisor, mortgage broker, or real estate agent, and this presentation is not a substitute for professional financial advice. The mortgage and real estate markets are complex and subject to change. Always consult with a qualified and licensed professional who can assess your individual financial situation before making any decisions about a home loan. Your financial future is your responsibility. You found it. The perfect house. It's got the open concept kitchen you've been dreaming of, the backyard for the dog, the extra bedroom for a home office. You can already see yourself living there. You've run the numbers a dozen times. And then your lender sends over the official loan estimate. You stare at that number, that monthly payment, and your stomach just drops. With today's interest rates, that dream payment is suddenly a nightmare. It's hundreds of dollars more than you budgeted for. It's the difference between living comfortably and being house poor for the next 30 years. It's a gut punch, a deal breaker. But what if I told you there's a type of mortgage that the majority of homebuyers completely ignore? One that could potentially slash that monthly payment by 3, or even $500 or more right from day one. What if there was a way to get a key to that dream house with a payment you can actually afford? Picture this: two families, the Smiths and the Joneses. They buy identical houses side by side for the exact same price, $500,000. The Smiths do what almost everyone does. They get a standard 30-year fixed-rate mortgage at, let's say, 7%. Their principal and interest payment is about $3,326 a month. Now, the Joneses, they do something different. They get a 7-year ARM, and their lender gives them an initial interest rate of 6%. Their monthly payment, $2,997. That's a difference of $329 every single month. Over the first year, the Joneses save almost $4,000. Over the first 7 years, while the Smiths are paying their higher rate, the Joneses will have saved over $27,000. That's enough for a new car, a massive boost to their retirement savings, or a dozen incredible family vacations. They unlock this massive savings by understanding a financial tool that, frankly, scares the heck out of most people. And let's be honest, the moment I said the words adjustable rate mortgage, a little alarm bell probably went off in your head. You might have had a flashback to news reports from 2008, stories of financial crisis, foreclosures, and families losing their homes. The term ARM became a 4-letter word, synonymous with risk, uncertainty, and financial ruin. And because of that fear, an entire generation of homebuyers has been conditioned to believe that the 30-year fixed is the only safe, responsible choice. That belief, while understandable, could be costing you tens of thousands of dollars. This video is going to change that. We are going to pull back the curtain on one of the most misunderstood and powerful mortgage options available to U.S. homebuyers today: the 7-year ARM. We're not just going to define it, we're going to demystify it. I'm going to show you exactly how it works, why the ARMs of today are dramatically safer than the ones that caused the 2008 crash, who this type of loan is an absolute game changer for, and just as critically, who should run in the other direction and never look back. By the end of this, you will have the clarity and confidence to decide if a 7-year ARM is the secret weapon you need to win in today's tough housing market. So let's start with the absolute basics. What on earth is a 7-year ARM? The name itself sounds a little intimidating, but the concept is surprisingly simple. Let's break it down. ARM stands for adjustable rate mortgage. The 7 in front of it is the most important part. Think of a 7-year ARM as a hybrid loan. It's like a movie with a major plot twist in the middle. It has 2 distinct phases. Phase 1 is the fixed rate period. For the first 7 years of your loan, your interest rate is locked in. It cannot and will not change. It doesn't matter if the Federal Reserve raises rates, if the market goes crazy, or if inflation skyrockets. For 84 straight months, your interest rate is fixed. It acts exactly like a standard fixed-rate mortgage. You get a predictable, stable monthly payment you can count on. Here's the kicker, and this is the whole reason people get these loans. The interest rate you get during this initial 7-year period is almost always significantly lower than the rate on a 30-year fixed mortgage at the same time. Lenders offer this lower rate, sometimes called a teaser rate, as an incentive. They are rewarding you for not locking them into a low rate for 3 entire decades. So right away, from your very first payment, you are saving money. Phase 2 is the adjustable rate period. This is the part that makes people nervous. After that 7-year anniversary passes, the fixed part of your loan expires. Your interest rate unlocks and can now change or adjust on a regular basis. This means your monthly payment could go up, or it could go down depending on the broader market interest rates at that time. Typically, after the first 7 years, the rate will adjust once per year. You might see this written as a 7/1 arm, which means it's fixed for 7 years, then adjusts every 1 year after that. Sometimes you'll see a 7/6 arm, which means it's fixed for 7 years, then adjusts every 6 months. The 7/1 is far more common. So, to put it as simply as possible, a 7-year arm gives you a lower, fixed interest rate for the first 7 years, and then it switches to an adjustable rate for the remaining 23 years of the loan. The next logical question is, why 7 years? Why not 6 or 8 or 12? The number 7 isn't random. It's strategically chosen to align with the real-world behavior of American homeowners. Think about your own life plans. Do you truly see yourself living in the exact same house 15, 20, or 30 years from now? For most people, the answer is no. Life happens. You get a new job and have to relocate. Your family grows and you need more space. The kids move out and you want to downsize. The data backs this up. According to the National Association of Realtors, the median tenure for a U.S. homeowner, the typical amount of time they stay in one home, is right around 10 years. And for first-time homebuyers, it's often even shorter. Now, connect that fact to the structure of a 7-year arm. The loan gives you a significant discount on your interest rate for 7 full years. If you know with a high degree of certainty that you are going to sell the house and move before or right around that 7-year mark, then you get all the benefits of the lower payment without ever having to face the risk of the adjustable rate period. You get the huge upfront savings for 7 years, and then you sell the house, pay off the loan, and walk away before your rate ever has a chance to adjust. You've essentially hacked the system. You enjoyed a lower mortgage payment for the entire time you own the home. This is the single most important concept to understand, and it's the primary reason why a 7-year arm can be an incredibly smart financial move for the right person. You're matching the timeline of your loan to the timeline of your life. Why pay a premium for a 30-year fixed rate, a rate that insures you against changes for 3 decades, if you're only going to be in the house for 7 or 8 years? It's like buying a 30-year warranty on a car you plan to sell in 7. It doesn't make sense. So we have this incredible tool that gives you a lower payment for a fixed period. But this all hinges on that big, scary moment when year 7 ends and year 8 begins. What happens then? Does the bank suddenly have the power to jack up your rate to 20% and kick you out of your home? This is the fear that paralyzes people. And the answer, thanks to major reforms after the 2008 crisis, is an emphatic no. Modern ARMs have multiple safety features built in called caps that strictly limit how much your rate can change. They are designed to protect you from payment shock. Understanding these caps is the key to conquering the fear of the unknown. So let's break down that armor. Imagine you're buying a car. You wouldn't just care about the top speed, you'd care about the brakes. The caps on an arm are the high-performance, anti-lock brakes for your mortgage. They are the non-negotiable rules of the road, written into your loan contract, that dictate how, when, and by how much your interest rate can ever change. There are typically 3 of them, and understanding them is like being handed the keys to the entire system. First, you have the initial adjustment cap. This is the big one. It governs the very first rate change that happens after your 7-year fixed period ends. Think of it as a speed bump, but a carefully measured one. After 7 years of cruising at a steady speed, this cap says, okay, the road conditions might change, but we're not going from 30 miles per hour to 100 in an instant. This first adjustment is often the largest one allowed over the life of the loan. A common initial cap might be 2% or sometimes 5%. Let's put some real numbers to this. Say you get a 7-year ARM on a $400,000 loan with an initial interest rate of 5%. For 7 full years, your payment is locked in. It's predictable. You can budget for it perfectly. At the beginning of year 8, your first adjustment happens. Let's assume the market rates have shot up. Without a cap, your rate could theoretically jump to anything. But with a 5% initial adjustment cap, the absolute highest your new interest rate can be is 10%. That's your 5% starting rate plus the 5% cap. Cannot, under any circumstances, go higher than that on this first change. It's a guardrail. Now, a 5% jump is significant, and we'll talk about how to plan for that. But the key is that it is a known quantity. It is not infinite. It's a defined risk, not a mystery. Of course, if market rates have only gone up by 1%, your new rate would just be 6%. The cap isn't a target, it's a ceiling. It only comes into play if the market forces are trying to push your rate up by more than the allowed amount. Next up is the second safety feature, the subsequent adjustment cap, sometimes called the periodic cap. This one is arguably even more important for long-term stability. After that first adjustment in year 8, your rate will then adjust every year after that, in year 9, year 10, and so on. The subsequent cap limits how much the rate can move in any of those following years. This cap is almost always smaller than the initial cap. A very common number here is 2%. Let's go back to our example. Your rate started at 5%. In year 8, let's say the market was crazy and your rate jumped the full amount to 10% because of that 5% initial cap. Now year 9 rolls around. Market rates are still climbing. Does your rate jump another 5%? Absolutely not. The subsequent adjustment cap kicks in. If that cap is 2%, the highest your rate could possibly go in year 9 is 12%. That's the 10% from the previous year plus the 2% subsequent cap. It prevents a series of massive back-to-back payment shocks. It forces the changes to be gradual, giving you time to see them coming and adjust your budget. It transforms a potential wildfire into a controlled burn. Each and every year after that first adjustment, the rate can never move up or down by more than that 2% limit. This creates a predictable step-by-step pattern of change, not a sheer cliff. This brings us to the third and most powerful cap of all, the lifetime cap. This is the ultimate safety net. This is the number that provides absolute peace of mind. The lifetime cap sets the maximum interest rate you could ever possibly pay over the entire 30-year term of your loan. No matter what happens in the world, no matter if inflation goes to the moon, no matter what the Federal Reserve does, your rate cannot exceed this ceiling. It is the final unbreakable rule. Typically, the lifetime cap is set at 5 or 6% above your initial starting rate. Let's stick with our example. A starting rate of 5% and a lifetime cap of 5%. This is a very common structure. This means that the highest your interest rate could ever be is 10%. Period. End of story. Let's trace the path again. You start at 5%. In year 8, the rate adjusts. In year 9, it adjusts again. Maybe in year 10, it adjusts again. But at no point ever can it climb past 10%. That is your absolute worst-case scenario. This single number allows you to do something incredibly powerful. You can calculate today the highest monthly mortgage payment you would ever have to make. Think about that. The biggest fear of an ARM is the fear of an unknown, unaffordable payment in the future. The lifetime cap removes the unknown. You can look at that 10% rate, calculate the monthly payment on your $400,000 loan, and ask yourself a simple, direct question. If the absolute worst happens, can I handle this payment? If the answer is yes, you've just defused the biggest bomb associated with an ARM. You've turned a gamble into a calculated risk. Lenders often express these 3 caps in a simple sequence of numbers, like 5/2/5. When you see this on a loan document, it's not confusing code. It's your safety manual. The first number is the initial adjustment cap, 5% for the first change. The second number is the subsequent adjustment cap, 2% for all following changes. And the third number is the lifetime cap, 5% over your starting rate. So a 7-year ARM with a 5% start rate and a 5/2/5 cap structure means your rate is 5% for 7 years. In year 8, it can't go above 10%. In year 9, it can't go above 12%, but wait, the lifetime cap of 5% means the absolute ceiling is 10%. So in this case, even though the subsequent cap is 2%, the lifetime cap of 5%, making a 10% ceiling, would override it. The lowest of the applicable caps always wins, protecting you. The rate can never break through that lifetime ceiling. Now you might be wondering, okay, the caps limit how much my rate can go up, but what is actually causing it to move in the first place? It's not arbitrary. Your lender doesn't just wake up and decide to raise your rate. Your rate is tied to 2 things: an index and a margin. The index is a publicly available benchmark interest rate that reflects general market conditions. Think of it like the price of gasoline. It goes up and down based on the wider economy. The margin is a fixed number of percentage points that the lender adds to the index. This is their profit. It's set in stone in your contract and never changes. So, your fully indexed rate is simply the index plus the margin. When it's time for your rate to adjust, the bank looks up the current value of the specified index, adds their fixed margin, and that's your new rate, unless that new rate violates one of the caps. The caps act as the ultimate referee. If the index plus margin calculation says your rate should jump 3%, but your subsequent cap is 2%, your rate only goes up 2%. The cap overrules the market formula. It is your personal consumer protection law, written directly into your mortgage. And it's important to remember this works both ways. If interest rates go down, your payment can go down too. The same adjustment rules apply. After your 7-year fixed period, if the index has dropped, your mortgage payment will decrease, giving you an unexpected financial boost. There is, however, usually a floor, meaning your rate can't fall below the margin. But the possibility of your payment decreasing is a potential benefit that fixed-rate mortgages simply don't offer. By understanding these 3 caps, initial, subsequent, and lifetime, you've moved from being a passenger to a pilot. You know the plane's limits. You know the safety features. You know the absolute maximum altitude it can reach. The fear of the unknown starts to fade, replaced by a clear understanding of a structured, rule-based system. But that still leaves the biggest question unanswered. What exactly is this index? Is it one single thing? Are there different kinds? And how can you track it yourself so you can see where your rate might be headed a year or even 2 years from now? The index is the engine driving the entire process, and understanding which engine is in your arm is the final piece of the puzzle to achieving total mastery over your loan. So let's open that final box in the puzzle. The index. Think of an index as the public, fluctuating benchmark that your loan is tied to. It's like the wholesale price of money. Your bank doesn't just invent a number out of thin air when it's time to adjust your rate. Instead, they look at a specific, publicly available financial index, and that index's performance dictates what happens to your mortgage payment. It's the adjustable part of your adjustable rate mortgage. The bank isn't the captain of the ship, deciding to steer into stormy waters. The index is the ocean current itself, and your loan is just along for the ride. Now, for decades, the undisputed king of these ocean currents was a benchmark called LIBOR. You've probably heard of it. The London Interbank Offered Rate. It was the index for everything: student loans, credit cards, and of course mortgages. It was supposed to represent the average interest rate at which major global banks could borrow from one another. It was a simple, elegant idea, but it had a fatal flaw. LIBOR wasn't based on actual observable transactions. It was based on what the bank said their borrowing costs were. It was an honor system. And if you put a few dozen foxes in charge of reporting how many chickens are in the henhouse, well, you can guess what happened. In the late 2000s, a massive scandal erupted. It turned out that some of these giant banks were colluding, deliberately submitting false, artificially low numbers to make themselves look financially healthier than they were, and to profit from trades. They were rigging the single most important number in global finance. The entire system was built on a foundation of sand. The public trust was shattered, and regulators around the world knew LIBOR had to go. It was like finding out the referee in the Super Bowl was betting on the game. The whole thing had to be torn down. So the search began for a new, better, more transparent benchmark. A system based not on what banks say but on what they actually do. And in the United States, the clear winner that emerged is a benchmark called SOFR. That's SOFR, the Secured Overnight Financing Rate. And that name tells you everything you need to know about why it's so much more reliable. Let's break it down. First, secured. Unlike LIBOR, which was unsecured, SOFR is based on loans that are secured by the safest asset on planet Earth, U.S. Treasury bonds. These are actual real-life transactions where institutions lend money to each other overnight, using Treasury bonds as collateral. There's no guesswork. There's no estimation. There's no honor system. We're talking about hundreds of billions, sometimes over $1 trillion in actual verifiable transactions happening every single day. The data is real, it's robust, and it's published every morning by the Federal Reserve Bank of New York. It is virtually impossible to manipulate. This is a massive upgrade in safety and transparency for you, the homebuyer. Next, overnight financing rate. This just means it's based on the cost of borrowing money for a very short period, just overnight. This makes SOFR incredibly sensitive to the actions of the Federal Reserve. When you hear on the news that the Fed raised interest rates, the SOFR index will reflect that change almost immediately. It's a pure, direct measure of the current cost of money in the U.S. financial system. So if you have a 7-year arm tied to SOFR, you're essentially hitching your mortgage to the most transparent, high-volume, and difficult-to-rig benchmark ever created for the U.S. dollar. But SOFR isn't the only game in town, although it is the most common one you'll see today. Another popular index, especially with certain lenders, is the CMT, or the Constant Maturity Treasury Index. While SOFR is based on overnight loans, The CMT is based on the yields of U.S. Treasury securities themselves, like the one-year Treasury bill. Think of it this way. SOFR measures the cost of borrowing money for one night using treasuries as collateral. The CMT measures the return you'd get by lending money to the U.S. government for 1 year. They are two sides of a very similar coin, and they tend to move in the same direction, tracking overall interest rate trends. So which one is better? It's less about better and more about different. SOFR, being an overnight rate, can be a little more volatile day to day. It reacts instantly to the Fed's moves. The one-year CMT can be a little smoother, since it's based on the market's expectation of rates over a full year. Some people prefer the stability of the CMT, while others prefer the pure transparency of SOFR. The most important thing isn't to pick a winner, but to know which index your specific loan is tied to, and to understand how it behaves. Your loan documents will state this explicitly. It will say something like SOFR 30-day average, or one-year CMT. Don't just gloss over that detail. It is the engine of your loan. So let's bring this all back to your wallet. After your 7-year fixed period is over, your lender will perform a simple calculation to determine your new interest rate. They take the current value of your specified index. Let's say the one-year CMT is at 4.75%, and they add your margin to it. Remember the margin? That's the fixed percentage the bank adds on top. If your margin is 2.5%, your new fully indexed rate would be 4.75% plus 2.5%, which equals 7.25%. That becomes your new interest rate for the next year. Until the next adjustment period. The index goes up, your rate goes up. The index goes down, your rate goes down. The margin never ever changes. But here's a crucial little secret. A piece of information that gives you a small but powerful advantage. It's called the look-back period. Your lender doesn't just wake up on the day of your rate adjustment, check the index, and surprise you with a new payment. That would be chaotic. Instead, the rules state they must use the index value from a specific point in the recent past. Typically, it's 30 or 45 days before your adjustment date. Why is this so important? Because it gives you a crystal ball. It means you don't have to guess what your new rate will be. You can literally look up the value of your index, be it SOFR or the CMT, 45 days before your rate is set to change, do the math yourself by adding your margin, and you will know to the penny what your new mortgage payment is going to be well over a month in advance. There are no surprises. This look-back period is your early warning system. It's a built-in buffer that gives you time to prepare and budget for the change, removing the fear of the unknown that so many people have about ARMs. You can literally see the future of your mortgage payment. Understanding your index, whether it's the modern transparent SOFR or the steady CMT, transforms you from a passenger into a navigator. You know where the current is flowing because you can look it up on your phone any day of the week. You know about the look-back period, so you have an early warning system. You've demystified the adjustable part of the loan. But we've only solved half of the equation. We've talked about the index, the part that moves. But what about the part of your rate that never changes? The part that's locked in stone for 30 years, even on an adjustable loan? That's the margin. And the margin is where the bank makes its profit, and it's where you can find hidden opportunities and hidden risks when you're shopping for your loan. It's the most misunderstood part of any ARM, and it's what we're breaking down next. So let's pull back the curtain on the margin. In the simplest terms, the margin is the lender's fixed profit on your loan. Think of it like a grocery store. The store buys a gallon of milk from a farmer at a wholesale price. That wholesale price can change every week depending on supply and demand. That's the index. But the store needs to make a profit, so it adds its own fixed markup to that wholesale price. That markup is the margin. So the price you pay for milk is the wholesale price plus the store's markup. Your adjustable interest rate works the exact same way. Your rate is the index plus the lender's margin. The index goes up and down with the market, but the margin is permanent. It is tattooed onto your loan agreement for the next 30 years. It does not change, ever. This is the single most important concept to grasp about an ARM. The low introductory rate you see advertised? That's temporary. It's a 7-year fling. The margin? That's the marriage. It's the part that sticks with you for the long haul, for the remaining 23 years of your mortgage. And this is precisely why two 7-year ARMs that look identical on the surface can be wildly different financial time bombs. Let me show you with a story. Let's meet two homebuyers, Sarah and Tom. They're friends buying similar houses in the same neighborhood. Both decide a 7-year ARM is the right fit for them, and they're both getting a $500,000 loan. Sarah is focused on getting the lowest possible monthly payment right now. She shops around and finds a lender, let's call them Flashy Bank, offering a stunningly low 5.25% introductory rate. She's thrilled. Her initial monthly payment on that $500,000 loan is about $2,758. She signs the papers feeling like she won the lottery. Tom is a little more cautious. He finds a lender, we'll call them Steady Bank, that offers him a 7-year ARM at 5.5%. It's a little higher than Sarah's rate. His initial monthly payment is about $2,839, so he's paying about $80 more per month than Sarah. On the surface, it looks like Sarah got the better deal. But Tom did something Sarah didn't. He ignored the big, bright, shiny introductory rate and went looking for the margin in the fine print. Flashy Bank, the one that gave Sarah the super low 5.25% rate, has a margin of 3%. Steady Bank, the one that gave Tom the slightly higher 5.5% rate, has a margin of 2%. For the first 7 years, this difference doesn't matter at all. They're both locked into their introductory rates. Sarah's happily saving her $80 a month, and Tom is paying a little bit more. They both live their lives, renovate their kitchens, and watch their kids grow. Then year 8 arrives. The adjustment period. Let's imagine that over those 7 years the economy has changed, and the index that both of their loans are tied to, let's say it's the SOFR rate, has risen to 5%. This is a realistic scenario. Now we calculate their new interest rates using that simple formula. Index plus margin. Let's look at Sarah first. Her new rate is the 5% index plus her permanent, unchangeable 3% margin from Flashy Bank. Her new interest rate is 8%. Her monthly payment skyrockets from $2,758 to a shocking $3,588. That's an increase of over $800 a month. Overnight, her budget is shattered. The deal that looked so good for 7 years has suddenly turned into a financial nightmare. Now let's look at Tom. His new rate is the same 5% index plus his permanent 2% margin from Steady Bank. His new interest rate is 7%. His monthly payment goes up from $2,839 to $3,254. That's an increase of about $415. It's not fun, nobody wants their payment to go up, but it is dramatically more manageable than Sarah's situation. By paying a little more upfront, Tom saved himself from a catastrophic payment shock. Sarah was seduced by the low initial rate, the teaser rate, and completely missed the poison pill hidden in the margin. The bank gave her a discount for 7 years, but they built their long-term profit into that high margin, knowing they would make it all back and more over the next 23 years. The margin is the true DNA of your adjustable rate mortgage. It tells you the fundamental cost of borrowing money from that specific lender, stripped of all the temporary discounts and marketing gimmicks. So, where do you find this critically important number? It's not hidden in some secret vault. By law, lenders have to disclose it to you on a standardized document called the loan estimate. You'll receive this 3-page form from any lender within 3 days of submitting a mortgage application. Get that document, and on page 1 in the loan term section you'll see your initial interest rate. But then, look further down in the projected payments table. There will be a section that shows how your payment can change over time. Right near there, or sometimes described in an addendum, the lender must disclose the index and margin. It will literally say index and margin, and list the percentages. Don't see it? Ask your loan officer. Where on my loan estimate can I find the specific index and margin for this loan? Do not proceed until you have that answer in writing. When you're comparing loan offers, you should create a simple spreadsheet. Column 1, lender name. Column 2, introductory rate. Column 3, index. And column 4, the most important one, margin. A lender offering a 5.5% intro rate with a 2% margin is almost always a better and safer long-term bet than a lender offering a 5.25% intro rate with a 3% margin. Now, the question you're probably thinking, can you negotiate the margin? The answer is, sometimes. It's not as easy to negotiate as other closing costs or points. The margin is often tied to the bank's internal risk and profit calculations. However, if you are a very strong borrower, meaning you have a high credit score, a low debt-to-income ratio, and a significant down payment, you absolutely have leverage. You can say to a lender, I have an offer from another bank with a 2.25% margin. I like your service, but I can't move forward with your 2.75% margin. Can you do anything to match it? They might say no, but they might also say yes. Shaving even 0.25% off your margin is a permanent win that could save you tens of thousands of dollars over the life of the loan. It never ever hurts to ask. So, the margin isn't just a random number in the fine print. It is the core of your loan structure. It dictates your interest rate for the majority of the loan's term. A low margin acts as a buffer, a shock absorber that protects you when the market index inevitably rises. A high margin acts as an amplifier, turning a small market change into a massive payment shock that can put your home at risk. Understanding the margin is what separates a savvy homebuyer from a future foreclosure statistic. It's the key to turning an ARM from a risky gamble into a strategic financial tool. But the margin doesn't work alone. It works hand in hand with the set of safety features built directly into your loan. These are your interest rate caps. They are the guardrails that prevent your rate from flying completely off the road, even if the index and margin are pushing it higher. And these caps are the final crucial piece of the ARM puzzle that we need to put into place. Think of these caps as the specific rules of the road for your interest rate. The guardrails are there, but the caps tell you exactly how sharp the turns can be and how high the road can climb. They are your contractual protection against the absolute worst-case scenarios, and they come in 3 distinct forms: the initial adjustment cap, the subsequent adjustment cap, and the lifetime cap. Understanding these 3 numbers is non-negotiable. It's the difference between being a passenger on a wild ride and being a confident driver who knows the route. Let's start with the big one, the one that causes the most anxiety: the initial adjustment cap. This cap limits how much your interest rate can change the very first time it adjusts after your 7-year fixed period is over. This is, without a doubt, the most significant adjustment you will face, because it represents the first potential payment shock. For 7 years, you've had a predictable, stable payment. Then, on day 1 of year 8, everything changes. The initial cap is designed to soften that blow. For example, let's say you have a 7-year ARM with an initial rate of 5%. Common initial cap might be 2%. This means that at that first adjustment, your rate cannot increase by more than 2 percentage points no matter what the index is doing. So, if the index has shot up and your fully indexed rate calculates out to, say, 8%, your initial cap kicks in and says, nope, not so fast. Your new rate can't be 8%. The highest it can go is your original 5% plus the 2% cap, for a new rate of 7%. This cap provides a buffer, a transition period. Some lenders, however, offer a higher initial cap, maybe 5%. In that same scenario, a 5% cap would allow your rate to jump all the way from 5% to 10% in that single first adjustment. You can see immediately how crucial it is to know this number. A 2% initial cap is a gentle on-ramp to the adjustable period. A 5% initial cap is more like a rocket launch. Next, we have the subsequent adjustment cap, also called the periodic cap. After that first major adjustment, your rate will typically adjust every year. The subsequent cap limits how much the rate can increase or decrease in each of these following adjustment periods. This is the rule that prevents a runaway train scenario year after year. It keeps the changes manageable and predictable on an annual basis. Let's continue our example. Your rate adjusted from 5% to 7% at the start of year 8. Now, at the start of year 9, it's time for another adjustment. The subsequent cap is also often 2%. This means your rate can't go up by more than 2 percentage points from its current level. So, from 7%, the highest it could possibly go is 9%. Even if the market index has gone completely haywire and is screaming for a 10% or 11% rate, this cap holds it back. It ensures a steady step-by-step change rather than a sudden terrifying leap. It works on the way down, too. If rates were to plummet, this cap could also limit how quickly your rate drops, though that's less of a concern for most borrowers. Finally, we have the most important safety net of all, the lifetime cap. This is the absolute ceiling. It's the highest your interest rate can ever go, for the entire 30-year life of the loan. Period. Full stop. No matter what happens in the global economy, no matter how high the index soars, your rate can never, ever exceed this lifetime limit. It's your ultimate protection, the final word in the contract. The lifetime cap is usually expressed as a number of percentage points above your initial starting rate. A very common lifetime cap is 5%. So, if your ARM started at 5%, your lifetime cap would be 10%. That means for the next 23 years of your loan, through recessions and booms, your rate will never be 10.1%. It will never be 11%. It is contractually forbidden from ever going past 10%. Knowing this number tells you your absolute worst-case monthly payment. It allows you to ask yourself, If everything goes wrong and my rate hits its maximum, can I still afford this house? If the answer is yes, you have a manageable risk. If the answer is no, you might be taking on too much. Now you'll often see these three caps expressed together in a series of three numbers, like 2/2/5 or 5/2/5. This is the secret coat of arms. But now you can crack it. The first number is the initial adjustment cap. The second is the subsequent adjustment cap. And the third is the lifetime cap. So a 2/2/5 cap structure on a 5% loan means the first adjustment is capped at 2%, so it can't go above 7%. Every subsequent adjustment is capped at 2% from the previous rate. And the lifetime cap is 5% over the original rate, meaning it can never exceed 10%. A 5/2/5 cap structure is much riskier upfront. It means that first adjustment can be a whopping 5%, potentially taking your rate from 5% to 10% in a single day. But after that, the subsequent adjustments are still limited to 2% per year, and the lifetime cap is still 5% over the start rate. Let's walk through a complete real-world scenario to see how all these pieces, the index, the margin, and the caps work together. Meet Alex. Alex buys a home with a 7-to-1 arm. Her initial interest rate is 6%. Her loan documents state that her margin is 3%, the index is the SOFR, and her cap structure is 2/2/5. For the first 7 years, life is simple. Alex pays her mortgage based on a 6% interest rate. It's predictable and stable. She knows exactly what to expect. But as year 7 comes to a close, she prepares for her first adjustment. She looks up the SOFR index and it has risen significantly. Let's say the current SOFR is 5.5%. To find her new market rate, the bank adds the index and the margin. 5.5% index plus 3% margin equals 8.5%. A jump from 6% to 8.5% would be a huge shock to Alex's budget. But she remembers her caps. Her loan has a 2/2/5 structure. The first number, 2, is her initial adjustment cap. This means her rate cannot increase by more than 2 percentage points at this first adjustment. So her original 6% rate can go up to a maximum of 8%, 6% plus 2%. Even though the market calculation is 8.5%, the cap overrides it. Alex's new rate for year 8 is 8%. The cap just saved her from a higher payment. Did its job. Now a year goes by. Alex is at the start of year 9, facing her second adjustment. The economy is still turbulent, and the SOFR index has crept up even higher, to 6%. The new market rate calculation is now 6%, index, plus 3% margin, equals 9%. Alex's current rate is 8%. She looks at her cap structure again, 2/2/5. The second number, 2, is her subsequent adjustment cap. This means her rate can't increase by more than 2 percentage points from its current level. Her current rate is 8%, so the highest it can go this year is 10%, 8% plus 2%. Since the market rate of 9% is lower than the 10% her cap would allow, her new rate becomes 9%. In this case, the market dictated the rate because it fell within the cap's limit. Let's imagine one final extreme scenario. It's now year 15. There's a major global financial crisis, and the SOFR index has skyrocketed to an unbelievable 10%. The calculated market rate would be 10%, index, plus 3% margin, equals 13%. This would be a catastrophic payment increase for Alex. But she remembers her final guardrail. Her cap structure is 2/2/5. That third number, 5, is her lifetime cap. It means her rate can never, ever be more than 5 percentage points higher than her initial rate of 6%. So 6% plus 5% equals 11%. That is her absolute ceiling. Even though the index and margin are screaming for a 13% rate, her contract protects her. Her rate is capped at 11%, and it will never go a penny higher for the life of the loan. This is the power of caps. They don't eliminate risk, but they define it. They put a fence around the uncertainty. Without them, an arm would be a wild, untamed financial instrument. With them, it becomes a calculated tool. You have your fixed period for stability, your index and margin that dictate the market changes, and your caps that serve as your ultimate safety harness. Now that we have all the components laid out on the table, we can finally begin to assemble the answer to the most important question of all. We understand what a 7-year arm is. We understand how it works. Now, is it actually a good idea? To answer that, we need to split the world of homebuyers into two distinct groups. For one group, a 7-year ARM is a ticking time bomb, a financial trap that can snap shut with devastating consequences. But for the other group, for the right person in the right circumstances with the right plan, a 7-year ARM isn't just a good idea, it's a brilliant one. It can be a strategic tool that unlocks doors you thought were welded shut. It can be the key that gets you into a home you thought was years out of reach. So let's start there. Let's build the case for the 7-year ARM. Let's talk about the immense power it can put in your hands and exactly who should be reaching for it. The single biggest, most attractive, headline-grabbing advantage of a 7-year ARM is the lower initial interest rate. This is the bait on the hook. And it's not a small difference. We're often talking about a rate that's 0.5%, 1%, or sometimes even more below the going rate for a 30-year fixed mortgage. Now, why is that? It all comes down to risk. For a lender, a 30-year fixed-rate mortgage is a massive 30-year bet. They are guaranteeing you that exact rate for 3 decades, through all the ups and downs of the global economy, inflation, and market turmoil. That's a long time to be locked into a promise. Because they are taking on that enormous long-term risk, they charge you a premium for it in the form of a higher interest rate. But with the 7-year ARM, the lender is only guaranteeing your rate for 7 years. Their risk is dramatically lower. They only have to predict the market for a relatively short window. Less risk for them means a lower price for you. You're not paying for 30 years of security. You're only paying for 7. And that discount can have a seismic impact on your monthly budget. Let's put some real numbers to this because this is where the theory becomes reality. Imagine you're looking to borrow $400,000 for a new home. You go to the bank and they offer you 2 options. Option 1 is the 30-year fixed mortgage at, let's say, 7%. Using a standard mortgage calculator, your monthly payment for principal and interest would be roughly $2,661. Option 2 is the 7-to-1 ARM. Because the bank has less risk, they offer you a much sweeter deal for those first 7 years. An interest rate of 5.5%. At that rate, your monthly payment for the same $400,000 loan is just $2,271. That's a difference of $390 every single month. Let that sink in. That's a car payment. That's your utility bills and your internet. That's a significant portion of your grocery budget. $390 is not pocket change. It's a meaningful improvement in your monthly cash flow. But it gets even more powerful when you zoom out. Let's look at the total savings over that 7-year fixed period. That $390 per month, multiplied by 84 months, which is 7 years, adds up to $32,760. Over $32,000 in savings. That's a new car. That's a down payment on an investment property. That's a massive boost to your retirement savings. It's a life-changing amount of money, and it's the direct result of choosing the ARM. This lower payment doesn't just save you money, it also dramatically increases your purchasing power. This is the second major advantage. Mortgage lenders qualify you based on something called a debt-to-income ratio. They look at how much you earn versus how much you owe, and they determine the maximum monthly housing payment you can afford. Since a 7-year ARM comes with a lower monthly payment, it means that on the very same income, you can qualify for a larger loan. Let's flip our example. Let's say you've done your budget, and you know you can comfortably afford a principal and interest payment of $2,500 per month. If you're going for that 30-year fixed loan at 7%, the maximum loan you could qualify for with a $2,500 payment is about $375,000. But if you opt for the 7-year ARM at 5.5%, that same $2,500 monthly payment suddenly allows you to borrow almost $440,000. That's a $65,000 difference in purchasing power. Think about what that means in the real world. That could be the difference between a 2-bedroom condo and a 3-bedroom house. It could be the difference between a neighborhood you're okay with and a neighborhood with the top-rated school district for your kids. It could be the difference between a house that needs a ton of work and a house that's move-in ready. For many buyers, especially in expensive markets, that extra purchasing power isn't just a nice bonus. It's the only way they can afford a home that actually meets their family's needs. So we have a lower payment and more buying power. This brings us to the most important question: who is this actually for? And the third, and perhaps most compelling, advantage of a 7-year ARM is that it is the perfect financial tool for the short-term homeowner. Our culture is obsessed with the 30-year fixed mortgage. We see it as the gold standard, the responsible choice. But we need to ask a critical question. How many people who buy a home today will still be living in that exact same home 30 years from now? The data says not many. The average American homeowner moves roughly every 10 to 13 years. And for first-time homebuyers, that number is often much, much lower. Think about the classic starter home buyer. A young professional or a newly married couple. They buy a small house or a condo. They plan to build their careers, maybe start a family. They know with near certainty that in 5, 6, or 7 years, their lives will look completely different. They'll need more space, a bigger yard, a different school district. Their plan was never to stay for 30 years. For this person, paying the premium for a 30-year fixed rate is like paying for a 30-year warranty on a car you plan to sell in 7 years. It makes no sense. You are paying for 23 years of rate security that you will literally never use. The 7-year ARM aligns perfectly with their life plan. They get to enjoy the massive savings and increased purchasing power for the entire time they own the home, and then they sell the property and move on long before that first interest rate adjustment ever becomes a threat. This same logic applies to anyone with a predictable relocation on the horizon. Think about members of the military who know they'll get new orders in 4 or 5 years. Or a medical resident who knows that after their 5-year residency, they'll be moving to a new city for a permanent job. Or a corporate executive on a specific 5-year assignment. For these individuals, the ARM isn't a gamble. It's a calculated, strategic choice. The end of the 7-year fixed period is irrelevant, because their moving boxes will already be packed. Finally, there's a fourth, more advanced advantage: using the ARM as a strategic cash flow tool. Even if you aren't 100% sure you'll be moving, the savings generated by the lower rate can be weaponized to improve your financial position. Remember that extra $390 a month from our example? Instead of just spending it, what if you used it to aggressively pay down your highest interest debt, like credit cards or personal loans? You'd be using the low-interest mortgage to eliminate high-interest debt, cleaning up your balance sheet at an accelerated rate. Or, even more powerfully, what if you took that $390 and made an extra principal payment on your mortgage every single month? You'd be using the bank's own discount to pay down your loan faster. You would build equity at a much higher speed and reduce the outstanding balance significantly. By the time year 7 rolls around and the rate is set to adjust, your loan balance would be much smaller, lessening the impact of any potential rate increase. You're actively reducing the future risk using the savings from the present. So let's recap the case for the 7-year ARM. It offers a significantly lower monthly payment, which translates into tens of thousands of dollars in savings. It boosts your purchasing power, allowing you to afford more house on the same income. It is the perfect, tailor-made product for anyone who knows they will be moving within the 7-year window. And it can be used as a tool to accelerate debt paydown and build equity faster. It sounds almost too good to be true, doesn't it? A lower rate, more buying power, a financial cheat code. And for the right person, it is. But every cheat code has a cost. Every shortcut has a potential pitfall. And the pitfalls of a 7-year ARM, well, they can be life-altering. Because what happens when your 7-year plan doesn't go according to plan? Let's talk about the single biggest risk, the monster under the bed of every adjustable rate mortgage: payment shock. It's a term that sounds almost cartoonish, but I assure you, the reality is anything but. It's the financial equivalent of diving into what you think is a warm swimming pool, only to find out it's ice cold. The shock is sudden, brutal, and can leave you gasping for air. When your 7-year fixed period ends, your interest rate doesn't just nudge upwards. It resets. It recalibrates to the market, and that first adjustment is often the most severe. Imagine your comfortable mortgage payment, the one you've built your entire family budget around for 7 years. Let's say it's $2,500 a month. You pay it without thinking. It's a line item like groceries or the car payment. Now imagine opening your mail one day and seeing a letter from your lender. Your new payment isn't $2,500 anymore. It's $3,200, or $3,500, or more. An extra $1,000 a month. That's $12,000 a year. Where does that money come from? Is that the vacation fund? The retirement savings you've been diligently putting away? Is that the money for your kids' braces or their college fund? For most American families, an unexpected $12,000 a year expense isn't an inconvenience. It's a catastrophe. That is payment shock. And it happens because the perfect 7-year plan, hit a snag. What kind of snag? Let's look at the 3 most common ways a 7-year ARM can turn from a dream into a nightmare. First, there's the refinancing trap. This is the most common assumption people make. They think, oh, the low rate is great. And before the 7 years are up, I'll just refinance into a 30-year fixed loan. Easy. And in a perfect world, they're right. But we don't live in a perfect world. To refinance, you need 3 things to be in your favor: a good credit score, verifiable income, and a favorable interest rate environment. What if, in year 5, you have a medical emergency? Suddenly you're saddled with unexpected debt, and your credit score, which was a pristine 780, dips to 650. Lenders who were once eager for your business now see you as a higher risk. The best rates are off the table if you can even get approved at all. Or what if your career changes? Maybe you decide to leave your stable 9-to-5 to start your own business. It's your dream, but for the first 2 years, your income on paper is low, maybe even a loss. When you go to refinance, the bank doesn't see a passionate entrepreneur. They see inconsistent income and deny your application. And the biggest factor, the one you have absolutely zero control over, the market itself. If you took out your 7-year ARM when rates were at 3%, but now 7 years later the prevailing rates for a 30-year fixed are at 7%, what have you gained? You're forced to either accept a massive payment increase on your ARM, or refinance into a new fixed loan at an even higher rate than your ARM adjusted to. You're trapped. The escape hatch you were counting on has vanished. The second pitfall is the market value meltdown. This is for everyone who says, "I'm not worried, I'll just sell the house before the rate adjusts. I'll be gone in 5 or 6 years anyway." This strategy treats a home not as a place to live, but as a short-term investment. And like any investment, its value can go down. We all saw this happen in 2008. People bought homes with ARMs, planning to flip them in a few years for a tidy profit. The market was hot. Prices were only going up. Until they weren't. When the bubble burst, home values plummeted. Suddenly, people owed $300,000 on a house that was now only worth $200,000. They were underwater. They couldn't sell. Selling would mean bringing $100,000 in cash to the closing table just to get out from under the loan. They were stuck. And then their ARM adjusted. Their payments skyrocketed on a house that was a massive financial liability. They were trapped in a home they never intended to keep, with a payment they could no longer afford. It was a perfect storm that led to millions of foreclosures. Believing you can just sell is a bet on the future of the housing market. And the market is a fickle, unpredictable beast. The third pitfall is the income illusion. This is the belief that your income will grow significantly over the next 7 years, making any future payment increase easily manageable. You think, sure, the payment might go up by $1,000, but by then I'll be making $30,000 more a year. It'll be a piece of cake. Banking on a future promotion, a career change, or a spouse returning to the workforce is incredibly risky. What if the promotion goes to someone else? What if your industry is disrupted and you get laid off? What if life circumstances, like caring for an aging parent or having another child, change your household's financial picture? You took out the loan based on a projection, an optimistic future version of yourself. But you're stuck making the payments as the real-world, present-day version of yourself. The ARM doesn't care about your projections. It operates on the mathematical reality of today's interest rates. So how does this adjustment actually work? It's not random. It's governed by a set of rules you agree to on day one. These are the caps, and understanding them is non-negotiable. First, you have the initial adjustment cap. This dictates the maximum your rate can increase the very first time it adjusts after the 7-year period. This is often the biggest jump. A common structure is a 5/2/5 cap. That first 5 is your initial cap. It means your rate cannot jump more than 5 percentage points at the first adjustment. So if your starting rate was 4%, the highest it could possibly go in year 8 is 9%. Next is the periodic adjustment cap. This is the second number in that 5/2/5 structure. The 2 means that after the initial adjustment, your rate can never go up or down by more than 2 percentage points in any subsequent adjustment period, which is usually every year. Finally, there's the lifetime cap. This is the last 5 in our example. It represents the absolute ceiling your interest rate can ever reach over the entire life of the loan. It's typically set at 5 or 6 percentage points above your initial starting rate. So if you started at 4%, your rate will never ever exceed 9% under a 5% lifetime cap. This is your worst-case scenario. When you're considering an ARM, you must do the math. You have to calculate the monthly payment at that lifetime cap rate and ask yourself, honestly, could my family survive this payment? Not thrive, but survive. If the answer is no, you cannot afford that ARM. The rate itself is based on 2 components: the index and the margin. The index is a benchmark interest rate that reflects general market conditions, like the SOFR, or secured overnight financing rate. The lender doesn't control this. It goes up and down with the economy. The margin is the lender's profit. It's a fixed percentage, say 2.5%, that gets added to the index. The margin never changes. So, your new rate is simply the current index plus the fixed margin. If the SOFR index is at 4% and your margin is 2.5%, your new interest rate is 6.5%, subject to your caps. Ultimately, a 7-year ARM is a transfer of risk. A 30-year fixed mortgage puts all the long-term interest rate risk on the bank. They are betting that rates won't go up so much that they lose money on your loan. They charge a higher initial rate for that security. An ARM does the opposite. It transfers all of that long-term risk from the bank directly onto you, the homeowner. You are the one betting that rates will stay low, or that your income will go up, or that you'll be able to sell or refinance. You're getting a lower rate for 7 years in exchange for shouldering that risk for the next 23. And you have to decide if that discount is worth the gamble. So let's talk about that gamble. Because for the right person, in the right situation, it's not really a gamble at all. It's a calculated strategic move. A 7-year ARM isn't a one-size-fits-all solution. It's a specialized financial tool. And like any specialized tool, it's incredibly powerful in the right hands and incredibly dangerous in the wrong ones. The most important question you can ask is, which hands are mine? Let's paint a picture of the ideal candidate for a 7-year ARM. Meet Dr. Anya Sharma. She's just finished her medical residency and has accepted a fellowship position. For the next 3 years, her salary is fine. It's not great, especially with her mountain of student loans. But she knows with absolute certainty that in 3 years she will become an attending physician, and her income will triple. Literally overnight. She and her partner want to buy a house now, to start a family in a good neighborhood. They look at a 30-year fixed mortgage, and the monthly payment is uncomfortably high. It would make their next 3 years incredibly tight. But then they look at a 7-to-1 ARM. The interest rate is a full percentage point lower. That difference drops their monthly payment by hundreds of dollars. For them, this isn't a 30-year loan. It's a 3-year loan with a 4-year safety buffer. They are taking the 7-year ARM because they have a rock-solid, predictable, and significant income jump on the horizon. When that rate adjusts in 7 years, her income will be so much higher that even a worst-case scenario payment increase would be easily manageable. More likely, they'll refinance into a 15-year fixed mortgage in year 4 and pay the house off aggressively. For Dr. Sharma, the ARM is a bridge. It's a tool that allows her to afford the house she needs now, based on the income she knows she will have later. Or consider the Peterson family. Major Peterson is in the Air Force. He just received orders for a 6-year assignment at a new base. They know with near certainty that in 6 years they will be moving again. They have no intention of keeping this house long-term. For them, a 30-year fixed mortgage is like paying for a 30-year insurance policy on a house they plan to own for 6 years. It makes no sense. Why would they pay a higher interest rate for 24 years of stability they will never use? They opt for the 7-to-1 ARM. They get a lower rate, a lower monthly payment, and save thousands of dollars over the 6 years they live there. Their exit strategy is baked in from day one. They will sell the house when the military reassigns them. The rate adjustment in year 7 is completely irrelevant to them because they will be long gone. For the Petersons, the ARM isn't a gamble on the future. It's a product perfectly tailored to their predictable, shorter-term timeline. Finally, think about Marcus, the real estate investor. He's buying a property to use as a rental. His goal is to maximize monthly cash flow. The lower the mortgage payment, the more profit he makes each month. He chooses a 7-to-1 ARM to keep his carrying costs as low as possible for the first 7 years. His plan isn't to hold the property for 30 years. His plan is to use the first 5 years to build a history of rental income, let the property appreciate, and then either sell it for a profit or do a cash-out refinance to pull money out and buy another property. The ARM is a tool to boost his return on investment in the short to medium term. He understands the risk of the rate adjustment, but he has multiple exit strategies and the financial savvy to navigate them. These are the people for whom a 7-year ARM is designed. People with a clear plan, a predictable life event on the horizon, or a specific investment strategy. They aren't hoping things will work out. They have a concrete reason to believe they will. But for every Dr. Sharma, Peterson family, or Marcus, there are people for whom a 7-year ARM is a financial landmine, waiting to detonate. And you need to be brutally honest with yourself about which camp you fall into. Who should run, not walk, away from an ARM? First, the forever homer. This is the couple who finds their dream home in the perfect school district. The one they talk about hosting grandkids in someday. They have no plans to move ever. For them, the single most valuable feature of a mortgage is predictability. Knowing that their principal and interest payment will be the exact same number in year 25 as it is in year 2 is a priceless peace of mind. Paying a slightly higher interest rate for a 30-year fixed loan is not an expense. It's an investment in decades of financial stability. The potential savings of an ARM for 7 years simply aren't worth the risk of 23 years of uncertainty. Next, and this is the most critical one, is the budget stretcher. This is the buyer who can only just qualify for the home they want by using the lower introductory rate of an ARM. They look at the 30-year fixed payment and it's out of reach, but the 7-year ARM payment squeaks them through the approval process. This is, without a doubt, the most dangerous way to use an ARM. You are not just gambling on future interest rates. You are gambling with your ability to afford your home at all. If the lower payment is the only way you can make it work, you are starting your homeownership journey on a knife's edge. A rate increase in year 8 won't just be an inconvenience. It could be the difference between keeping your home and foreclosure. If you can't comfortably afford the payment on a 30-year fixed-rate loan for that same house, you are likely buying too much house, and the ARM is masking that fact. Finally, there's the anxious planner. This is the person who is naturally risk-averse. They lose sleep over market fluctuations. The idea of their single biggest monthly expense being a variable number causes them genuine stress. For this person, the math is secondary to their mental and emotional well-being. Even if an ARM could save them money, the cost and anxiety isn't worth it. The premium paid for a fixed-rate mortgage buys them something invaluable: certainty. So, if you're a good candidate, you still need a plan. Your escape hatch. Let's break down the 3 primary exit strategies from an ARM. The first is refinancing. This is the most common plan. The idea is simple. Before your rate adjusts, you'll get a new loan, hopefully a fixed-rate one, to pay off the ARM. But refinancing is not a guaranteed right. To get a new loan, you have to requalify. That means you'll need a solid credit score, a stable income, and a low debt-to-income ratio at that future date. If you've lost your job, taken on a lot of car or credit card debt, or if your credit has taken a hit, you might not be approved. Furthermore, refinancing costs money, typically 2 to 5% of the loan amount in closing costs. And most importantly, it depends entirely on what interest rates are doing in 7 years. If rates have shot up, you might be forced to refinance into a fixed rate that's even higher than your ARM suggested rate. The second exit strategy is selling. This is the Peterson family's plan. It's clean and effective, but only if you actually move. And it's not free. Selling a house is expensive. Between realtor commissions, closing costs, and transfer taxes, you can expect to pay anywhere from 6 to 10% of the home's sale price. That means your home needs to have appreciated by that much just for you to break even. If the market is flat or has gone down, you could end up having to bring cash to the closing table just to sell your home. This brings us to the third and perhaps most powerful strategy, the one that gives you the most control. You don't refinance, you don't sell. You attack the principal. Think about it. The 7-year ARM gives you a lower monthly payment than a 30-year fixed. But what if you don't use that savings to spend more? What if you pretended you had the 30-year fixed mortgage payment anyway? You calculate the difference between your low ARM payment and what the payment on a 30-year fixed would have been, and you pay that difference directly toward your principal every single month. By doing this, you're using the bank's own tool against them. You're not just saving on interest in the short term, you're dramatically reducing the loan balance. When year 8 rolls around and the rate adjusts, it will be applied to a much smaller principal amount than the bank originally calculated. This blunts the impact of the rate increase significantly. You've built a massive equity cushion, you've reduced your overall debt, and you've put yourself in a position of power. This strategy requires discipline, but it turns a risky loan into a powerful wealth-building tool. It's your proactive plan, not a reactive hope. But for some people, even the best laid plans can go sideways. And that's why we need to have a brutally honest conversation about who should run, not walk, away from a 7-year ARM. This isn't about being pessimistic. It's about being realistic. An ARM is a specialized tool, and if you use it for the wrong job, it will break on you. So, who are the people who should stick to the safety of a traditional 30-year fixed-rate mortgage? First, there's the forever home buyer. This is the person or family who has found their spot. They're planting an oak tree in the backyard, not a flower pot on the balcony. They plan on being in that house for the next 15, 20, even 30 years. For them, the primary goal isn't short-term savings. It's long-term predictability. They want to know that their principal and interest payment in year 17 will be the exact same as it was in year 3. For this buyer, taking on the interest rate risk of an ARM, even with a 7-year fixed period, is simply a bad trade. The potential savings over those first 7 years are dwarfed by the potential anxiety and financial uncertainty of the next 23. If you are absolutely certain you're not moving for a very long time, the peace of mind that comes with a 30-year fixed is priceless. Next up is the stretch to the max buyer. This person has crunched the numbers and they qualify for the loan, but just barely. Their debt-to-income ratio is high, and the monthly payment on the 7-year ARM represents the absolute ceiling of what they can afford. They have no wiggle room. This is perhaps the most dangerous scenario of all. For this buyer, the ARM isn't a strategy. It's a key to a house they can't truly afford. They are betting their entire financial future on the hope that rates will be lower in 7 years, or that their income will have skyrocketed. But hope is not a strategy. When the adjustment period hits, even a small 1% increase in their interest rate could be the difference between making the mortgage payment and facing foreclosure. If the only way you can afford the house you want is by using the lower introductory rate of an ARM, you are buying too much house. Period. Then we have the income uncertainty buyer. This could be a freelance graphic designer, a real estate agent working on commission, a startup employee with a compensation package heavy on stock options, or anyone in a volatile industry prone to layoffs. Their income isn't a straight line. It's a series of peaks and valleys. The fundamental problem here is trying to pair an unstable income with a potentially unstable housing payment. It's financial chaos. When you have a great quarter, paying a higher mortgage might seem easy. But when a dry spell hits, and your mortgage payment suddenly adjusts upward at the exact same time, it can create a perfect storm of financial distress. These buyers need stability in their largest monthly expense. A fixed-rate mortgage acts as an anchor, a predictable cost they can plan around, even when their income is anything but predictable. Finally, there's the financially undisciplined buyer. This person understands the strategy we talked about before, using the monthly savings to pay down the principal aggressively. They nod along, they get it, they love the idea. But if they're being truly honest with themselves, they know they won't do it. That extra $200 or $300 a month saved won't go towards the mortgage. It'll go towards a new car payment, a vacation, or more dinners out. There's no judgment here. It's just human nature. For this person, the slightly higher payment of a 30-year fixed mortgage isn't a bug. It's a feature. It's a form of forced savings. It automatically ensures they are building equity at a steady, albeit slower pace. They are paying for discipline. An ARM in the hands of someone without the discipline to execute the pay-down strategy is just a ticking time bomb. So, if you see yourself in any of those profiles, a 7-year ARM is likely not your friend. The risk simply outweighs the reward. But what is the actual risk? What is this monster in the closet called the adjustment period that these buyers are so rightly afraid of? Let's stop talking about it in vague terms. Let's pull it out into the light and dissect it piece by piece so you understand exactly how it works. When your 7-year fixed period ends, your interest rate becomes variable. It will typically adjust once per year for the remaining 23 years of the loan. But how is that new rate calculated? It's based on a simple formula: index plus margin. First, the index. This is a benchmark interest rate that reflects general market conditions. For many years, the go-to index was called LIBOR, but that's been phased out. Today, the most common index you'll see is the SOFR, which stands for the Secured Overnight Financing Rate. You don't need to know the complex mechanics of how SOFR is calculated. All you need to know is that it's a widely published number that goes up when the economy is hot and borrowing is expensive, and it goes down when the economy is cool and the Fed is trying to encourage borrowing. Your lender has zero control over the index. It is what it is. The second part of the formula is the margin. This is the lender's piece of the pie. It's a fixed percentage that is added to the index to determine your rate. For example, the margin might be 2.75%. Unlike the index, the margin is set in stone in your loan agreement. It will never change for the entire life of your loan. So the formula is, your new rate equals SOFR index plus lender's margin. But here's where it gets critical. Your rate can't just shoot to the moon overnight. The loan has built-in safety features called caps. These caps limit how much your interest rate can change, and they are the most important numbers to understand in your entire loan document. There are 3 of them. First is the initial adjustment cap. This cap limits how much your rate can increase the very first time it adjusts after the 7-year period is over. A common initial cap is 2%. This means if your starting rate was 6% on the first adjustment, your new rate cannot go higher than 8%, no matter what the index and margin formula says. Second is the periodic cap, or subsequent adjustment cap. This limits how much the rate can increase in all the following years. This is also often set at 2%. So, in year 9, your rate can't go up by more than 2% from your year 8 rate. In year 10, it can't go up by more than 2% from your year 9 rate, and so on. Third and most important is the lifetime cap. This is the absolute ceiling your interest rate can never ever exceed for the entire 30-year term of the loan. Typically, this is 5 or 6% above your initial rate. If your starting rate was 6% and you have a 5% lifetime cap, your rate can never go above 11% ever. It's your ultimate protection against a true worst-case scenario. So when you see an ARM advertised, you might see a set of numbers like 2/2/5. That's what they're talking about. A 2% initial cap, a 2% periodic cap, and a 5% lifetime cap. Let's walk through a quick real-world example. Let's say you get a $500,000 7-year ARM with an initial rate of 6%. Your caps are 2/2/5, and your margin is 3%. For 7 years, life is good. Your rate is 6%. Now year 8 arrives. It's time for your first adjustment. Let's say the SOFR index at that time is 4%. Your lender does the math. Index 4% plus margin 3% equals 7%. Your old rate was 6%. The new rate is 7%. Since the 1% increase is less than your 2% initial cap, your new rate is 7%. Your payment goes up. But what if it's a high-interest environment? Let's say in year 8 the SOFR index has shot up to 6%. The math would be index 6% plus margin 3% equals 9%. But wait, your initial cap is 2%. Your rate started at 6%, so the highest it can go on this first adjustment is 8%. The cap just saved you. Your rate adjusts to 8%, not the 9% the formula calculated. Your payment still goes up significantly, but the cap protected you from an even more extreme shock. This is the mechanics of risk. The caps are your safety net, but they are not a parachute. They soften the blow, they don't eliminate it. Understanding this math, this interplay between the index, the margin, and the caps is not optional. It is the absolute price of admission for even considering a 7-year ARM. So, with these complex mechanics, this potential for future shock, the single most important question becomes, who is this loan actually for? Who is the ideal candidate for a 7-year ARM, and who should run in the opposite direction? It's not about intelligence or wealth. It's about circumstance and strategy. Let's build a few profiles. First, meet the transitional homeowner. This is perhaps the most classic and safest use case for a 7-year ARM. Think of a young doctor and her partner who are moving to a new city for a 5-year residency program. They know with near certainty that they will be moving again once the residency is complete. They don't want to rent and throw money away, so they decide to buy. For them, a 30-year fixed mortgage is overkill. They're paying a premium for 23 years of stability they will never use. A 7-year ARM is perfect. It gives them a lower interest rate and a lower monthly payment for the entire time they plan to own the home. They save thousands of dollars over those 5 years, which they can put toward the down payment on their next, more permanent home. The risk of the rate adjusting in year 8 is completely irrelevant to them, because by then the house will have a new owner. The same logic applies to a military family on a 3 to 5 year assignment, or a corporate executive relocating for a specific project. If your timeline for owning a particular home is firmly under 7 years, the ARM aligns perfectly with your life plan. The risk is minimized because you plan to sell before the risk ever materializes. Next, let's consider the income accelerator. This is someone who is on a clear and predictable upward trajectory in their career. Imagine a lawyer who is on the partner track, or a software engineer who has stock options vesting in 4 years. They can comfortably afford the mortgage payment today, even at the fully indexed rate. But they are financially savvy. They see the 7-year ARM's lower initial rate, not as a way to squeak into a home they can't afford, but as a strategic tool to optimize cash flow. They take the lower payment for the first 7 years, and they invest the difference. Or they use that extra cash to pay down other, higher interest debt, like student loans. They've done the math. They've calculated their worst-case scenario payment after the first adjustment, and they know that by year 8, Their income will have grown so substantially that even a maxed-out payment won't strain their budget. For the income accelerator, the 7-year ARM is a calculated risk, but one that is heavily cushioned by their future earning potential. They are betting on themselves, and they have a very good reason to believe that bet will pay off. Finally, there's the rate game strategist. This individual is financially sophisticated. They follow economic news, they understand interest rate cycles, and they have a high tolerance for risk. This person might take out a 7-year ARM during a period of historically high interest rates. Their thesis is simple. Rates are sky high right now, but they're unlikely to stay this high for 7 straight years. They lock in the lower ARM rate, saving money month to month, while keeping a vigilant eye on the market. Their goal is to refinance out of the ARM and into a 30-year fixed mortgage the moment rates drop to a level they find attractive. They are using the 7-year fixed period as a window of opportunity. They're not planning to ride out the adjustment period. They're planning to exit the loan entirely before that happens. This is an advanced strategy. It requires discipline, a strong credit score to ensure they can refinance, and a solid backup plan if rates don't fall as expected. This is not for the faint of heart, but for those who understand the market, it can be a powerful way to navigate a volatile rate environment. Now, just as important, who is this loan not for? The list is clear, and if you see yourself here, you should proceed with extreme caution or, more likely, not at all. First, the forever homeowner. If you are buying the house you plan to raise your children in, the one you see yourself living in for the next 15, 20, or 30 years, the uncertainty of an ARM is a massive, unnecessary gamble. The small amount of money you might save in the first 7 years is dwarfed by the potential for decades of payment anxiety. For you, the 30-year fixed mortgage isn't just a loan. It's a pillar of stability. It's the peace of mind of knowing that your largest monthly expense will be the exact same on day 1 as it is on day 10,000, regardless of what the economy does. Don't trade long-term peace of mind for short-term savings. Second, and this is the most critical one, the stretched buyer. This is the person who can only qualify for the home because of the lower initial ARM rate. Their budget has zero wiggle room. A 1% increase in their interest rate would be the difference between making their payment and facing foreclosure. If this is you, an ARM is not a tool, it's a trap. This was the central story of the 2008 financial crisis. People were sold on the dream of a low teaser rate without fully understanding, or being able to handle, the payment shock that was waiting for them down the road. If you cannot comfortably afford the payment at the fully indexed rate, the index plus the margin on the day you sign the papers, you cannot afford the loan. Period. Do not bet your financial future on the hope that things will just magically work out in 7 years. Finally, the financially anxious. A mortgage is a financial product, but your home is an emotional sanctuary. If the very idea of your payment changing in the future is going to cause you stress, if you're going to lose sleep in year 6 worrying about what the LIBOR or SOFR rate will be in year 8, then an ARM is not for you. The psychological cost outweighs the potential financial benefit. Some people thrive on managing variables and risk. Others need certainty and predictability to feel secure. Know which type of person you are. There is no shame in choosing the simpler, more predictable path of a fixed-rate mortgage. Your mental health is worth more than a few tenths of a percentage point. So, as we wrap this up, what is the final verdict on the 7-year ARM? It is neither a hero nor a villain. It is a specialized financial instrument. Think of it like a scalpel. In the hands of a skilled surgeon who knows exactly when and how to use it, it can be precise, effective, and incredibly useful. But in the hands of someone who doesn't understand the anatomy of the financial body it's operating on, it can cause devastating harm. The choice is not about finding a secret hack to homeownership. It's about conducting an honest and rigorous self-assessment. Before you even consider a 7-year ARM, you must be able to answer these 4 questions with absolute clarity. 1. What is my realistic, honest-to-goodness timeline for living in this house? Not your dream, but your most probable plan. 2. What is my financial forecast? Is my income stable? Is it reliably set to increase? Or is it uncertain? 3. Have I done the worst-case scenario math? Can I truly, comfortably afford the monthly payment if my interest rate adjusts to its lifetime cap? Don't estimate. Calculate it. And 4. What is my personal tolerance for risk? Do I crave stability? Or am I comfortable managing a calculated financial gamble? A 7-year ARM is not a shortcut. It is a strategic choice for a specific type of homebuyer with a specific plan. For the right person, it's a brilliant move. For the wrong person, it's a catastrophic mistake. The power, as with all things in finance, doesn't come from finding a loophole. It comes from understanding the rules of the game better than anyone else. It's about choosing your path with your eyes wide open, not with your fingers crossed. Make your choice an informed one. Your future self will thank you for it.